Right, we're good. Good morning, ladies and gentlemen, and welcome to Bring It On 2021. We have people joining us online from all over the world this morning, and I hope wherever you find yourself and whatever restrictions you're facing, that you're safe and well. Let me start off by painting a picture of what we'll be covering this morning. I'll kick off in a moment with 5 minutes or so to update our progress in launching a new bank. I'll then hand over to Mark Field, who until 2019 was the Conservative MP for the cities of London and Westminster for 18 years, and for the past year has been chairman of CIB Limited, our new bank, who will share his insight into the year that lies ahead. David Long, our Chief Investment Officer, will offer his expert insight into the macro and micro factors affecting the investment world this year, to be followed by Greg Easton, our Business Development Manager for Investment, who will share his passionate views on the importance of ESG and in particular biodiversity. The speeches were aiming to finish by 9:30, then there'll be a chance to pose questions to any of the speakers. To do this, to the right of the video screen you will see the word event. If you click on that and then click on chat, you'll be able to type your questions in there. We'll take as many of these as we can at the end. Please keep these focused on the matters in hand. The last webinar we did, we had some people selling unrelated products in the chat until we kicked them out. One final point by way of introduction, as part of our own green initiatives, we've partnered up with the Isle of Man Woodland Trust, and we will be funding the plantation of one tree for every person that is in attendance today. So let's get started. You'll have noted a sense of confidence, resilience and optimism in naming our annual conference this year, Bring It On 2021. We're saying 2020 was challenging, but 2021 we're ready for you. With a Brexit deal finally done, a vaccine being distributed and a Biden administration only a week away, the foundations for a new start in 2021 have been set with the challenges and disruption of 2020 behind us. So I thought the metaphor for this conference was going to be one of new starts, a new dawn for us to move forward towards normality with optimism. Let's see how 2021 is working out so far. The virus is spreading faster than ever, with daily corona death appearing to have peaked at over 1,000 a day in the UK, which has resulted in lockdown 3, hospitals near breaking point, schools closed, exams being cancelled and further disruption to our neighbours across the water. Closer to home, after 6 months of unrestricted life as normal on the Isle of Man, with no COVID cases in the community, our borders closed and strong enforcement of self-isolation for returning residents, a small but potentially very damaging outbreak of COVID cases over the Christmas period has forced the island to move quickly and enter a strict circuit breaker 3-week lockdown since Thursday last week. And simply unbelievable scenes in Washington last week as the sitting US president incited thousands of people to lay siege to Capitol Hill. Not only does this tell us things we probably already knew about Donald Trump, but also the power of the media and his ability to shape beliefs. The YouGov poll of nearly 1,400 registered US voters taken on the 7th of January, the day after the riots, found that 45% of Republicans actively support the actions of those at Capitol Hill. And across all parties, 21% said they were supportive. But despite all of that excitement at the start of 2021, I wasn't tempted to reframe the conference to stormy waters, and I still think optimism and a new dawn is a valid metaphor for the year ahead. Others will quite rightly take a differing view, pointing to outrageous valuations, exceptional debt bubbles, the threat of negative interest rates and so on. But you will inevitably make up your own mind, and I hope today's speakers will help you with that. But first, let me give you a quick update on our work to launch a new digital corporate bank. A year ago at our January conference, I introduced Mark Field as the chairman for CIB, Capital International Bank. Our goal at that time was to get the bank open in 2020, and we achieved that. We are launching the bank in 3 phases. The first phase launch was to open accounts for our own internal companies, and we achieved that on the 1st of December last year. Since then, we've been in effect using our own money for live testing purposes, and have successfully made payments in and out via chat, fax and faster payments. We've set up term and notice accounts. We've opened call accounts in 19 different currencies and placed live foreign exchange trades using all currency pairs. So far, so good. The next phase requires FSA approval, and we're working closely with them to move into phase 2 at the end of this month. During this phase, we'll transition around 25 existing Capital Treasury Services clients into CIB. They will use our digital onboarding platform with the support of our client engagement team, and we'll have their accounts opened within a day or two of them completing the online application, once our back office team has checked that all the documents are in date, etc. This will be a really important milestone because after months of performing thousands of tests, we'll have real live clients using our online banking platform for the first time. We'll also use this stage to capture live client feedback for any improvements we need to make to the client experience. And finally, if phase 2 goes smoothly and subject to FSA board approval, the final license restrictions will be lifted, hopefully around mid-April, and we will transition the remaining qualifying CTS clients over to CIB, and we can then open the doors to new business. During the design phase of the bank, I had over 65 meetings in 8 countries to gather feedback from CSPs, TSPs, wealth managers, family offices, professional services companies, and e-gaming businesses to learn what they needed from their banking partners. That research informed our whole design of the bank. The thing I heard every single time, loud and clear, was sort client onboarding out, as it can take not just weeks, but months to open an account. And sometimes at the end of that process, the answer might be no. To avoid the endless toing and froing, we've built our own digital onboarding capability, where you key all the data, upload the documents, and once your information has been successfully submitted, you'll get an approved standard risk account open within a couple of days. And for a non-standard case, for example, a PEP or a high-risk case, it'll take about a week. Even better than that, I challenged our teams to create a pre-application section where within 200 seconds, you'll find out if we are not able to open an account for you. So that within 200 seconds, if we're not able to help you, we won't waste your time or ours. And for those that fall into line with our risk tolerances, you'll get a guide to our fees, so there are no surprises along the way. During the onboarding process, the information builds a structure chart of the client, so no more handwritten scribbles being faxed into the bank. And because the decision as to whether to approve an account is taken by our people here in the Isle of Man, you'll get a quick, pragmatic, local decision because we understand our target sectors and our target markets. No more faceless decisions made a long way from the client. For CSPs that might have directors on many companies, there is an address book feature so they can reuse all their KYC info at the touch of a button rather than rekey it multiple times. You can set up your authorizations online at the outset and change them in seconds if someone leaves your organization or you want to change a payment limit or a sign-off authority for FX. And finally, as a new bank, we've created a fiduciary deposit product that allows us to place your deposits off our balance sheet with other highly rated banks, so you don't need to be overly concerned about placing large deposits with a new unrated bank. As a reminder, our license is a Class 1-2 banking license for non-retail clients, so we've built it around the needs of corporates in the offshore markets. Exciting times. It's taken nearly 4 years to get to this point, but within a few weeks, we'll be doing our bit to support businesses here in the Isle of Man and further afield. I could talk for hours about this project, but it's time for me now to hand over to Mark Field, and I'll be back at the end for questions and answers.
Thank you, Greg. And good morning, everyone. Well, who knew? When we assembled here last January, in person, of course, no less, and I presumed to indulge in a little political prediction, unfolding events in Wuhan and on the Austrian Alps had just begun to feature in and around page 23 of the news pages. Now, the upheaval, the turmoil, and sheer uncertainty of the past 12 months recalls just how life must have been in 1915 or 1940, as those in established careers reflected on the wholesale and unexpected changes that the year gone by had brought to what seemed like stable, predictable existences. Who had any notion of what furlough, lockdown, and social distancing were only one short year ago? As I recall, my comments at this event last January focused on what already seemed like a long and winding road to Brexit, the finality of whose outcome we are even now probably a little too complacent about. But there had been a conclusive election in the UK, and that result had apparently provided more political stability than we had seen since the turn of the century. Oh yes, and I recall a few choice comments that came up, not least in the questioning, about the plight and the fate of Flybe. Do you remember? Those were the days when those mausoleum, previously known as airports, were teeming with people and aircraft. Now, enough, I think, of the navel-gazing for the past. Today, I want to give some thought to future trends, both macroeconomically and closer to hand, as to how the world of work may play out. I shall then touch on the UK's place on the global stage post-Brexit. And as the last Foreign and Commonwealth Office Minister for Asia and the Pacific, who's actually been able to travel regularly and extensively to those continents, I'll say a little bit about investment opportunities in that part of the world. Finally, given that the Isle of Man is, as we know, but a short hop, or indeed a jet ski, from both Scotland and Ireland, I shall touch on the political turbulence of the Union as I see it playing out in the decade that lies ahead. Now, truth be told, the UK economy was already not firing on all cylinders even before the pandemic struck. This time last year, many put that down to Brexit uncertainty and the political stalemate of 2018-19, which had adversely impacted direct foreign investment and compounded already weak productivity. Historically, major shocks to the economy and the current anticipated slump of 11% to GDP during the current tax year certainly counts as one of those, also provide unique opportunities to reset and to take advantage of profound accelerations in trends that were already in place. In my erstwhile constituency, the City of London, or perhaps I should say was, one of the most intense meeting places for globally oriented professionals. Over 500,000 daily commuters converged on the metropolis, comprising a little over a square mile, with fewer than 9,000 residents. The real hit throughout traditional business districts has been to the hitherto core strength, the economies of scale that flow from economic intensity and physical density. So is the age of the office over? I know that we've all been reading a lot of stuff in the newspapers in recent weeks and months about that. But will we all be working predominantly from home forevermore? I think let's take a step back. Video conferencing isn't new. Whilst the last century may have been the age of rather clunky video technology, Skype arrived on the scene as long ago as 2003. Cisco's webinar has been with us for a decade and a half. And even the relatively new kids on the block, Zoom and Microsoft Teams, were in business as long ago as 2013 and 2017, respectively. Of course, what is new, courtesy of the pandemic, is the near universal adoption of conferencing owing to travel restrictions internationally and domestically during lockdowns. The cost savings, along with the likely lack of demand from former jet setters to travel as extensively at the drop of a hat for work. Imagine the palaver, at least in the short term, of testing, tracing and quarantine that will make mass air travel even more unbearable. But I think all of this means that a genie is firmly out of the bottle. One observation, however, that I hear time and again from those who feel that working from home is here to stay is that some of those mixed model operations with some participants in a conference room and others in a range of video conferencing venues lacks authenticity. I think there's a fortune to be made from some tech pioneer to further democratize this process. Some other thoughts about lasting changes to the world of work. I think punctuality is now essential in the world of video conferencing, and there's going to be a creeping intolerance of those who are habitually dialing in late will become more widespread, as will a more general sense of impatience. Participants in virtual meetings of the future will need to keep it short and sweet. Snappy introductions and the use of ever more complex decks, I think, will become the norm. We all see more casual dress. I'm wearing a tie, actually, just I think that's what's expected of the chairman of the bank, but I think it's the first time I've done such a thing for at least 9 months. But will I ever need to buy another pair of black shoes or semi-formal cotton shirts? But alongside of that has come, I think, a sense of egalitarianism or democratization within meetings. The engagement in conversation, particularly of more junior staff, for example. There's a broader sense that I think in Teams and Zoom meetings, status will matter just a little bit less than the active contribution to virtual meetings, which will be encouraged from whatever source. These trends, I think, are here to stay. And when we begin to return to the more face-to-face encounters, I suspect the dynamics of business meetings will have changed for good. But return to personal contact, networking, and with it innovation will happen. The death of office life has, I think, been somewhat exaggerated, not least as all of us begin to understand the importance of some of those trivial chance 2-minute corridor conversations, often which spark a flow of spontaneous ideas, which are lacking in hour-long formal meetings. Now, this year marks the 500th anniversary of one of what I regard as the key turning points in modern human history. When in 1521, at the Diet of Worms, the writings of the controversial German pastor Martin Luther were proscribed by the Roman Catholic Church, the Reformation took on a new impetus. Questioning the central authority of the established church led to scientific, cultural, philosophical, economic and artistic freedoms that gave the West and Northern Europe, along with its offspring, the United States, Canada and Australasia, the key competitive advantage over this past half millennium. The absence of an all-embracing central authority has allowed all of us in the West to treat as the norm fresh thinking, new ideas, great and small, emerging from the complex interplay between people. This social capital has, needless to say, been the very essence of innovation and the future economic growth. It's also why I am, as you will probably have gathered, inclined to take a slightly more optimistic view of the UK's economic prospects for the year ahead than many commentators, including indeed the Chancellor himself, who understandably wishes to dampen any excessive euphoria until the vaccine has been widely administered. Whilst it's always advisable to underpromise and to overdeliver, we do find ourselves at a key crossroads. Confidence needs to be reasserted, and continued chatter of economic crisis and emergency conditions and measures can only undermine already tentative consumer demand and investor sentiment. But Brexit, even this side of December the 31st, 2020, hasn't gone away. Indeed, one of the more pernicious and abiding myths of Brexiteer law was that getting to a free trade agreement, or indeed settling for no deal, would represent a decisive and clean break from relations with the European Union. Nothing, of course, can be further from the truth. We are still left with the carnage of almost 5 decades of legal arrangements with the European Union to be unravelled, and the lack of trust that the last 4 years of stop-start negotiations has engendered makes for limited goodwill over the interpretation of differences that will inevitably emerge in the near future. There are virtually no set rules governing EU-UK relations in aviation, in electricity markets, pharmaceuticals, immigration control, yet alone over financial services. And as the local MP until late 2019, I witnessed the diminishing expectations of the City of London for our financial services relationship with the EU. Ambitions for passporting, to enhanced equivalence, to mutual recognition all came to naught. And finally, there's been a begrudging acceptance that in the short term at least, the EU needs to plug into London's wholesale capital markets, and will do so for now, but only because it is in the EU's self-interest. But history suggests that a bounce back from the deepest recessions is often dramatic. So we can expect to hear, I think, much more of a prospect of a rerun of the roaring 20s in this century. And whilst my inclination is always to be somewhat skeptical, especially as there now seems to be near euphoric unanimity and concessions about economic prospects, at least if one believes the financial markets, whilst leading FTSE shares have risen vertiginously as a consequence of massive, unprecedented global monetary and fiscal stimulus, the truth is that inventing a vaccine or 3 is one thing. Getting it distributed to over 7 billion worldwide will prove more tricky. Nevertheless, there is good reason to expect a strong recovery over the next 2 years. Evidently, some businesses, especially in heavily disrupted service sectors, will not make it, but many households, through prudent and enforced savings, have almost uniquely during recession improved their personal balance sheets. While some demand may remain subdued, the impact of the government stimulus indicates that there should be a welcome boost. Unlike overheating credit booms in the early 1970s and late 1980s, the Treasury in the near term has a sweet spot, has unsated demand, an economy operating at some 10% below capacity, and the potential of capitalizing on resurgent confidence. Inflation, of course, may yet follow from this menu, but not, in my view, anytime soon. But let's look, I think, more panoramically beyond the Brexit drama at what will the UK's place in the world be. As Greg pointed out, the incoming Biden administration in Washington, D.C. has made it clear that it will engage far more constructively than its predecessor with multilateral organizations. That, I think, augurs very well for the UK. For as we exit one large multinational organization, we have clear interests in the United Nations as a permanent Security Council member, in NATO, and at the OECD, to name just three. And only when the US is truly committed can such organizations function to their potential. We shall soon be hosting COP26, the largest international climate change conference since Paris some 6 years ago. This will be almost as important a staging post for the message that the US is back as it will be for us as hosts. I think it's in everyone's interests for the conference to have a 2012 Olympics-like aura around it. And given the avowed intent that the UK should be the go-to jurisdiction for green finance, for marine conservation, electrical vehicles, hydrogen investment, and carbon capture utilization and storage as technologies of the future, its importance cannot be overstated. And I know close to hand here in the Isle of Man, in so many of those areas, that we have a piece of the action, and hopefully we will be able to capitalize on that in the years to come. But naturally, life also goes on beyond these shores and this continent. In my old stamping ground of Asia and the Pacific, the RCEP, the Regional Comprehensive Economic Partnership, burned slowly from 2011 under the Indonesian leadership, but recent momentum saw it signed, sealed, and delivered to link in a free trade agreement, China, Japan, Australia, New Zealand, South Korea, and all 10 of the ASEAN nations. At a time when bilateral relations between China and Australasia are at an all-time low, there is some truth in the view that this partnership owes more to the momentum of years gone by, and it's worth recalling that negotiation began before President Xi came into office. But it's true also that the Chinese view is often that signing a treaty is the start rather than the end point of negotiations. Nevertheless, it is a clear signal that much of ASEAN is pragmatic about working with China on its doorstep. And it's worth noting also, rather pointedly, that India is not involved in the RCEP. Amidst the turbulence of the pandemic, perhaps little attention appears to have been paid to last autumn's Chinese Communist Party 5th plenum, which set out its strategic and economic path until 2035. In simple terms, this has heralded a reversion to a strategy of self-sufficiency, last seen during the time of Chairman Mao's, and only reversed really with the dramatic opening up after Deng Xiaoping's accession in 1978. Ostensibly favouring a move away from reliance on exports towards the promotion of a more consumption-based internal market, the CCP's guess is for the national self-sufficiency in food production, energy, technology, and an antidote to increasing hostility from the West, and a concern that globalization may be on the wane. Whatever concerns we here in the West have about the rise of China, unencumbered by democracy, press freedom, or the rule of law, in terms that at least that we would understand, one cannot but admire the sense of strategic perspective that its academics and policymakers apply to a rapidly changing world where few others seem to have abiding confidence in their values and institutions. As promised, a final word closer to home on the State of the Union. Now, it is my intention and hope that I shall be speaking at these capital conferences for many years to come, and I trust in Douglas in future too. So I'll make a prediction that I may yet live to forget and regret, but no doubt you'll remind me of. The union of the four nations of the United Kingdom is, I fear, in terminal decline. In its current incarnation, it celebrates, if that's the right word, its 100th anniversary on the 3rd of May this year, which was when Ireland was formally divided. The tensions of Brexit, the demographic changes in Northern Ireland, the failure of Scottish devolution to pacify nationalist passions, all of this and more points towards independence for Scotland and a reunited Ireland, probably within the framework of the next decade. It's not a prospect I relish, as I think it would also substantially diminish England and Wales, notwithstanding the fact that 88% of the UK's population lives in this part of the Union. However, what is good for the goose is presumably good for the gander. So I think it's a rich irony in the reaction of some of my erstwhile Brexiteer colleagues who were so keen for the UK to detach itself from the EU, who now seek at all costs to prevent the people of Scotland and Northern Ireland from reclaiming, as they might see it, or some of their political leaders on the nationalist side would, their own sovereignty. I'm not convinced that economics or a prolonged debate about which currency an independent Scotland would use will win the day this time round as it did in the 2014 referendum. After all, if there is one lesson from Brexit and the Brexit vote and its aftermath, it is that the emotion will often trump raw economics. People really will turn their mind to voting for an outcome that is likely to make themselves poorer, at least in the short term. But forgive me, I will end, if I may, on a more upbeat note. It has been my pleasure, as Greg has alluded to earlier on, to be engaged in commercial and professional matters here on the Isle of Man for almost a decade. In the last year, I've been the non-executive chairman of the Capital International Bank. And as we move to the full launch to which he referred in the spring, it has been an enthralling and an exciting time to be engaged in this venture that builds on the wonderful reputation that the Capital Group has established. At this time of trepidation and economic uncertainty, I sincerely and enthusiastically believe that Capital International Bank will be an important part of the Isle of Man's financial and professional infrastructure as the economic recovery is ignited. After a torrid year that has just passed, I believe there is much now to be confident and optimistic about as 2021 emerges. I now pass over, if I may, to the next speaker, someone who we all know well. I barely need to introduce him, the Chief Investment Officer of the Capital Group, David Long.
Thank you, Mark, and good morning to you all. I'm going to try a little bit of technology and share my screen, so bear with me. Okay, so it always feels like tempting fate to try and forecast financial markets, and never more so, I suppose, than during a global pandemic. So I approach it today with a certain amount of caution and the usual caveats. Indeed, this time last year, I gave a broadly positive update on our expectations for 2020, tempered only by some concerns over global debt and increasing financial stress. If I revisit my presentation from last year, I could only find a brief mention of coronavirus as a potential negative surprise, a comment that perhaps wins the award of understatement of the year. As we know, 2020 has been a year like no other, with the world facing its first truly global pandemic in over 100 years. While in Europe, there have been two distinct waves of infection, from a global perspective, 2020 has seen a fairly steady and consistent increase in the spread of the virus. This global perspective is important, reflecting the fact that COVID-19 has quickly become endemic, and the tide can simply not be turned back. The world must develop strategies to live with it. And in the West, vaccination is clearly the solution, but the developing world faces an altogether starker reality. The response of financial markets in 2020 was extraordinary. Major stock markets lost around a third of their value in about 3 weeks. As an investment manager, such a pullback in equities is not particularly unusual, but what was shocking was the movement in traditionally safe assets such as bonds and, for a time, gold. Indeed, for a period of about 2 weeks, financial markets became near dysfunctional. In hindsight, the 23rd of March presented long-term investors with perhaps the buying opportunity of the decade, although I can tell you it certainly didn't feel as much on the day. One investment director from another firm commented to me that the Friday was the worst day of his career. Panic, of course, is the enemy of good investment, and at times of extreme distress, it sometimes helps to remember your Shakespeare, who put it so eloquently, "This too shall pass." And so it did. Unprecedented monetary stimulus, coupled with signs that the first wave peak had passed, led to a sharp recovery in Q2. The FTSE 100 was the worst performing major market, but still managed to stage a 32% recovery from the low to the year end. Technology stocks were the big winners, with the US Nasdaq making all-time new highs as early as June and finishing the year up nearly 40%. Quite an extraordinary performance. Like most, our own strategies were hit hard during the collapse in February and March, but I'm pleased to note how strongly and consistently they recovered, ending the year with gains of up to around 4 or even 5%. I would have been satisfied with this at the start of the year, but given the circumstances, I believe it to be a tremendous result and a credit to the team. Looking forward, having seen such a strong market recovery and faced with the reality of surging infection rates and further lockdowns, what can we expect from 2021? Focusing for a moment on the UK, back in November, it seemed as if the second wave was reducing thanks to the tiered system of restrictions. However, a virus that is replicating itself trillions of times each day will quickly adapt to even the most preventative of measures. That proved to be the case in the UK, with a new variant evolving that clearly is able to transmit effectively despite the restrictions in place. As we know, cases in the UK have surged to new highs, more than twice the levels in November, believe it or not. More significantly, hospital admissions have now surpassed the peak of the first wave, and the NHS is fast running out of capacity. Thanks to improved treatment options, ICU beds have yet to hit the previous peak, but are rising sharply, as are mortality rates, which are likely to rise further over the next couple of weeks. In response, the UK entered its third national lockdown shortly after Christmas, with a further tightening of these restrictions now imminent. Facing such difficult realities, you might wonder why the FTSE 100 is actually up 5% so far in January. The answer is twofold. Additional monetary stimulus announced by central banks, and in particular the Federal Reserve, coupled with the vaccine deployment timetable. And this is critical because the UK has been one of the fastest countries to deploy vaccines, with 2.4 million doses already administered. Both the Pfizer and AstraZeneca vaccines are now on stream, and the Moderna vaccine is also approved, and the pace of vaccination is expected to ramp up to around 2 million inoculations a week, delivered through 7 mass vaccination centres opened yesterday and 1,200 additional centres around the country. At this pace, the first 4 priority groups should have their initial shots by the middle of February. This may only be about 15% of the population, but it's expected to have a transformative impact on hospitalization and mortality. If vaccines prove as effective as expected, nearly 85% of COVID deaths could be averted within 8 weeks. Of course, as we've already seen, there is a real risk that new mutations might reduce the vaccine effectiveness, but when coupled with the natural seasonality of the virus, it is likely now that we will face a dramatically different picture by April or May, and restrictions should begin to ease. One surprising feature of this recession is that households have on average built up substantial savings, estimated to total 200 billion in the UK alone. This, coupled with renewed freedoms in the summer, is likely to lead to a mini boom in activity. Capital Economics expect the global economy to grow by 6.9% in 2021, surpassing pre-COVID activity levels during the second quarter, and gaining a further 4.7% in 2022. If correct, this will be the fastest economic recovery in history. The UK is expected to be the fastest growing major economy this year, as it recovers from both COVID and Brexit, with growth forecast to be in excess of 7%, an extraordinary figure. Some of the big geopolitical risks that we were worrying about last year have also eased, most notably and most importantly, the US elections, where we have moved from the chaos and unpredictability of Trump to the welcome calm of President-elect Biden. The Democrats have also now won the Senate, giving a degree of certainty to US politics that markets have welcomed. And whatever its merits, a Brexit deal was eventually concluded in December, bringing to an end 5 years of extreme uncertainty for the UK and to a lesser extent Europe also. While there are many Brexit issues still to play out, most notably in financial services, it is no surprise that UK assets and the pound are starting to play catch up. The rebound in global growth is fueled by an unprecedented expansion in money supply. Central bank balance sheets increased by over $7.5 trillion last year, coupled with interest rates falling to close to or below zero in most major economies. What we learned about QE after the 2008-9 financial crisis is that the impact of money printing flows first into asset prices, and this is perhaps the main reason why markets have already recovered so well. It's also clear from the Federal Reserve's latest dot plot of policy expectations that we are likely to see interest rates lower for longer, and there is no expectation of increases in US rates until 2023 or beyond. We expected looser fiscal policy in 2020 long before the pandemic struck. In reality, we are now seeing fiscal expansion to previously unimagined levels. This is not just direct pandemic expenditure, but longer-term spending plans look set to expand rapidly over the next couple of years, with any notion of fiscal prudence being discarded, at least for the time being. All of this is stimulative for markets and economies in the short term, but of course there are major consequences to this opening of the monetary and fiscal floodgates. Last year I flagged my concern that global debt had breached the $250 trillion mark, or 3.5 times of global GDP. That figure now looks set to exceed $280 trillion this year. This level of debt is only sustainable whilst interest rates remain extremely low. But there is now a real threat to this in the form of inflation. With so much monetary stimulus and fiscal spending, it is difficult to imagine how this can be absorbed without triggering a sustained increase in inflation. And we're already starting to see this in the US and elsewhere. With inflation significantly higher than Treasury yields, buyers are starting to evaporate and yields are starting to rise at the same time as the US dollar is weakening. The 10-year US Treasury hit 115 this morning, which is a substantial increase from around 0.5% at the low point of the pandemic. If this process goes too far or too fast, it could trigger the next global debt crisis. And this is now a very significant risk. But in my view, it is unlikely to manifest itself during the immediate COVID recovery phase, as central banks will simply do everything in their power to prevent it. But nevertheless, the prospect of a sustained pickup in inflation must be reflected in investment strategies. Traditional safe assets, such as bonds and cash, are likely to underperform assets that can maintain their relative purchasing power. High-quality equities offer one of the best hedges against inflation, although as we know, they are already extremely expensive. The pandemic losers, such as leisure, travel, and even financials, may prove to be some of the recovery winners this year. Real assets, such as property and land, should also do well, so long as they're not overly indebted. One area of particular interest may be commodities, which on a relative basis are at a multi-decade low when compared to equities. So to summarize our tactical views for the first half of 2021, we are positive for equity markets overall, with the UK having the potential to deliver the biggest gains as it plays catch up in the short term. Japan and Europe could also do well as investors seek better value outside of the US. And US equities should continue to perform, but for sterling-based investors, those returns may well be undermined by a weakening dollar. Emerging markets, particularly in Asia, are likely to continue to do well, with China on track to become the world's largest economy within the next few years. There is almost no value in fixed income markets, save as a counterbalance for bad news. And treasuries provide protection only treasuries, I should say, and gilts provide protection during a real financial shock. Within the alternative space, we are relatively positive towards real assets such as property, precious metals, and other commodities. We also see infrastructure doing well as a direct beneficiary of fiscal expansion. So overall, a fairly positive outlook in the near term, but this view may change rapidly as we move through the summer. Optimism at the prospect of recovery may quickly fade as the reality of dealing with the aftermath of a pandemic becomes clear. The scars are very deep and they will take many years to heal. So let me now introduce our final speaker, Greg Easton, who is going to give you an insight into the future of sustainable investment and how this is affecting all aspects of our business, a theme that we call conscious capital.
Thank you, David, and good morning, everybody. And I'm just going to share my screen and slides as well. Whilst I'm doing that, we do have some poll questions set up for you, and you can find those on the right-hand side of your screens. So please do go and have a look and complete those before our Q&A. So if we have a look at ESG landmarks in 2020, ESG in 2020 became more mainstream than ever, and it was a breakthrough year in many ways. And that was sort of summarized when we saw NextEra, the world's largest supplier of wind power, overtaking Exxon and Chevron to become the world's most valuable energy company. To put that into a UK context, NextEra is now twice the size of BP. We saw the US withdraw from the Paris Agreement, albeit temporarily, as we've seen President-elect Joe Biden pledging to rejoin, and he's also confirmed that he'll be hosting a climate summit within the first 100 days in office. And as David and Mark mentioned, the Democrats winning the Senate runoff in Georgia has given the Biden administration a mandate to deliver their Green New Deal, which strengthens those tailwinds for renewables even further. And on the 6th of January, NextEra jumped 6.5% on the news, and clean energy companies across the board were up, in many cases, double digits. And also looking at new battery storage capacity in the US, we've seen that more than double during 2020. In the UK, we have seen the demand for electric cars growing despite the COVID crisis, and that's predominantly because of the announcement made that the sale of petrol and diesel vehicles will be banned 10 years earlier than anticipated in 2030. And the UK has also pledged to stop funding fossil fuel developments overseas. From a European perspective, we've seen the European Commission President Ursula von der Leyen secure a €500 billion Green Deal, the centrepiece of the EU's economic recovery plan. And across Europe now, renewable power exceeds fossil fuels. And even in China, which is still responsible for more greenhouse gas emissions than any other country, we've seen them commit to carbon neutrality by 2060. And as the world's biggest market for solar and wind power, we will see an increase in clean energy infrastructure spending as China begins its 5-year plan. But it hasn't been all good news for the environment in 2020 and the start of 2021. As recently as last week, we saw the Trump administration auctioning off portions of the Alaskan Arctic National Wildlife Refuge to oil drillers. And this is sort of a prime example of where climate change, biodiversity, politics and economics meet. And as Mark alluded to earlier, the UK will be hosting the UN Climate Change Conference COP26 in November. And this is 5 years on from the Paris Agreement. But we'll also have another conference this year in Kunming, China. We'll have the UN Biodiversity Conference, or COP15, with a real focus on nature loss and land use gaining prominence. So we have a quick recap of the Paris Agreement. What is it and where are we up to? Well, it's a legally binding international treaty on climate change, and it was adopted by 196 countries at COP21 in December 2015. And if all national governments meet their 2050 net zero emissions targets, warming could be as low as 2.1 degrees. And the goal is to limit global warming to well below 2 degrees, preferably 1.5 degrees by the end of the century. And importantly, the Paris Agreement works on a 5-year cycle of increasingly ambitious climate change action. And in 2020, we saw countries submit their plans for climate action and their development of that and their nationally determined contributions. And this chart here that we're sharing just sort of maps that out a little bit. And if you look and see the sort of pledges and targets, if we are in that area, then the warming will be in the 2.3 to 2.6% range, with the current policies 2.7 up to 3.1%. So whilst there is lots of action, there is still a long way to go in the climate battle. And just to illustrate that a little bit further, we can see where some of those commitments are coming from. And this is a heat map showing countries that have strengthened or set a stronger target, and those that haven't made any changes to their original commitments there. And as mentioned, 2020 really was a breakout year for renewable energy. And this chart just illustrates a little bit the comparison between oil and gas and the global renewables index. And you can see we've had this period since the Paris Agreement being signed 5 years ago, where really renewables have not progressed to a great extent. And there have been headwinds, particularly in the US. But we can see during the course of 2020, the EU Green Deal announced, and the tailwinds that we've seen for renewables have led to a marked increase in the value of renewable companies. Now, I wanted to move on and talk about biodiversity a little bit, because it has become increasingly prominent in our discussions and at the government level as well. And I think ESG strategies and climate change funds are now mainstream, and it's relatively simple to invest in renewable energy companies, and the tailwinds for the next 10 years are strong. But what we're now also seeing is the concerns over nature-related financial risks are growing, and a number of financial institutions and civil society organisations have endorsed the setting up of a task force on nature-related financial disclosures, and that's going to be modelled on the task force on climate-related financial disclosures. And with this rising demand for the task force to be launched at the Biodiversity Conference in China, we could see that conference being as important for biodiversity as the Paris Agreement was for climate change. So we do expect to see companies issuing more biodiversity footprint reports as part of their wider non-financial sustainability reports. And why is this such a pressing issue for investors and for economies? Well, if we have a little look at our biocapacity, this chart shows that actually we've been living beyond our ecological resources since 1970. And one element of this to pick up. I think lots of people have focused on carbon footprint, but what's becoming more and more relevant is the footprint of croplands and the sort of the depth and detail now that companies in the agricultural sector are going into to look at agricultural technology, to look at land use, to look at nature loss as key issues going forward. And if we have a look as an example of that, there's been much discussion about soy and the impact of soy on deforestation. And this chart just shows soy producers and users, the revenue dependency that they have, but also commitments that are starting to be made towards zero deforestation. Just to put some big numbers there, if we take Brazil, since the turn of the century, there have been 56.5 million hectares of tree cover lost due to sort of the increasing demand for agricultural land. And if you look at a lot of the major supply chains across the world, I think what we're starting to see now is that you may have a company that has its sustainability commitments, but actually what's happening downstream and upstream of that company is being analysed in far greater detail. And I think bringing it back to some of the earlier points and where we are now, still in the midst of the third wave of the pandemic, one thing that has become apparent is that actually there is a direct link between the pandemic and biodiversity loss through zoonotic risks. So zoonotic risks, zoonotic disease like COVID, like Zika, like MERS, like SARS, are diseases that jump from species to species. And we are now seeing the direct economic impact of those zoonotic risks. And the World Economic Forum indicates that the economic cost of the pandemic could be as much as $16 trillion globally. And so it's no surprise that as habitats have been destroyed through the last 2 centuries, and our incursions into nature's heartland have been greater and greater, we've become more exposed to previously unknown viruses, and there is a greater likelihood of humanitarian and economic crisis. I think one of the other main developments in 2020 was the release of a white paper from the World Economic Forum looking at measuring stakeholder capitalism. Now, over the last 10, 15 years, there have been many initiatives. There are many different scoring systems. There are many ways for investors to look at ESG. And what's happened with this development is to try and have a universally acceptable set of metrics for measuring ESG, and they're broadly set below 4 pillars of principles of governance, planet, people, and prosperity. And the idea is that these metrics will be consistent, comparable, and transparent. They'll be linked to the established Sustainable Development Goals, and companies that adopt them and that are measuring and reporting these sustainability risks are, we believe, better placed to be managing these risks as well. And as mentioned, there are many different ways to measure ESG of different ESG scores of different companies, and this is just one example, the MSCI ESG ratings, where they have a grading system, and we use this information along with other scoring metrics to analyze companies and their ESG credentials, and this has led to an evolution for us of how we conduct our equity research, how we think about companies from a non-financial perspective. And as David mentioned, we're looking at this as conscious capital, and it really is a metamorphosis of our investment decision making and a vision to try and address those twin challenges of climate change and biodiversity through long-term sustainable creation. And it's an evolution of our existing equity research that places material emphasis on ESG quantitative and qualitative analysis. It does utilize a matrix of established ESG scoring, but importantly, it's not over-reliant on that, because I think you have to have that in-house research as much as being reliant and informed on external scoring systems. And really for us, it's about having a focus on making rational, wise investment decisions based on fundamentals rather than having a morally judgmental approach. And also, I think one of the challenge for investors is cutting through all the greenwashing that there is out in the market as ESG investing has become more prominent. So what are we doing about it? Well, we have our Fusion ESG strategy, which is a 100% ESG investment solution. It's transparent, so investors can see every single asset that we hold within that portfolio. It focuses on 4 main themes: sustainable agriculture, clean energy, water, and healthy living, that we believe are themes for the next decade. And just to finish before we move on to the Q&A and bring back Mark, David, and Greg, just wanted to sort of highlight, I suppose, that 2021 does provide an opportunity to start setting your ESG objectives, whether you're a trustee, whether you're a private client, whether you're a financial advisor. And I think the note from David Attenborough is very relevant to us today. And it's crazy that our banks and our pensions are investing in fossil fuels when these are the very things that are jeopardizing the future that we're all saving for. So if I may, I'll invite the other speakers to join me back on stage, and I'll stop sharing our slides. And hopefully you've all had an opportunity to go into our poll area as well and complete the responses there. So, Greg, if I may, I'll hand back over to you for the Q&A.
Excellent. Thank you, Greg. I hope everyone can hear me. Thank you for we've only got one question so far. I've got a couple here that I'd like to ask. So if any of you have questions, if you click on the tab that's entitled Stage and start typing your question, I'll pick that out in a moment. One thing I would say, you can see the number of viewers we've had. At our peak, we had 147. So I think we'll round that up and call it 150, and we will be funding the planting of 150 trees with the Isle of Man Woodland Trust, which is super to reinforce our commitment to the messages that Greg Easton has just shared with us there. David, I've got a question for you that I'm going to come to first, because I read an interesting article in the Times this morning around Bitcoin. We've seen the price of Bitcoin rise to 30,000 sterling in the last few days. It fell off in the last day or so, and the FCA issued a warning of it, around it for retail investors. Can you give me your professional take on the case or not for investing in Bitcoin?
Okay, thank you, Greg, for that fastball. It came at me. We could do a whole seminar on Bitcoin, and I'll separate my answer into 2 parts. I guess the first part is the prospect of alternative currencies, which I really do believe is likely to be the theme of the next decade or 2. And I think that we are approaching a very different world in terms of value exchange and currency developments, which will be quite profound in terms of its impact. And Bitcoin, of course, is the first of those that has now been in existence for, well, only about 12 years or so, and is clearly in the headlines, having reached something like $42,000, I think, last week. It's come back 20% or so since then. My personal view of Bitcoin itself is that you can see the answer to the question, is it an alternative currency for the world, in its price action? And the answer to that question is no, it's not. Because you can't have a currency that is flying around at such extraordinary rates in different directions. It's simply untenable. And I think the question we have to ask, if we own Bitcoin, is to what extent are we actually using it for day-to-day transactions? And most people I ask that question of, the answer is very little. we're buying it because it's going up in value and for not much else in the way of reason. And so I'm cautious of Bitcoin. However, I've been cautious of Bitcoin for the last 5 years, and that's clearly a huge mistake. And I just come back to my first point: alternative currencies is a massive theme for the next 15 years or so. So we do need to watch this space.
Thank you, David. If I bring you back to more gentle territory, we've got a question here from Paul Colley. Given the poor value of gilts and government bonds, what do you suggest as alternatives for long-term sustainable, low volatility return investments as a replacement for these traditional safe havens? Good question.
Sorry. So, I mean, it's a very good question. We are facing the prospect of a period of time where we see rising inflation, rising interest rates, and that will have the effect of dampening returns across pretty much all assets and all asset classes. If you think back, we've experienced a 20-year period, in fact, probably slightly longer, of continuously falling rates, and that has propelled asset prices. And so answering the question of what can we own that will do well during a period of rising interest rates and rising inflation is very challenging to answer. The answer is you have to own things that can maintain their purchasing power over time. Equities are one of those assets, and they've proven themselves over long periods of time to maintain their purchasing power. But of course, valuations are a big problem for equities, and they're also volatile. Cash tends to be a very poor asset during this kind of period. But other real assets like property, land, commodities, precious metals should all do reasonably well.
Thank you, David. We had a question on Bitcoin or crypto from James Chapman. Will CIG be able to hold Bitcoin or crypto in the future like many of the large US and Swiss banks? This is a really interesting question, James. It's an area I'm interested in. One of the challenges we have at the moment is the correspondent banks that we have to deal with. And I know there's a consultation across many of the regulatory bodies at the moment looking at the viability of crypto assets. As you pointed out, the US and Swiss banks seem to be slowly seeking to adopt it as an asset class. It's on our kind of review radar at the moment. We're not in a position to do that right now, but we are interested, and we will see how the regulatory environment adapts over coming years to see whether that is a possibility. There's a great question here from Devon Watson that I'm going to come back to you, David. QE has caused massive asset price growth which has primarily increased wealth for those that hold large concentrations of capital. Governments are likely to lower their national debt by slashing public services. Do capital managers not see political instability as a future harm to growth?
Yeah, absolutely. It's a great observation and great question. Yes, you're absolutely right. There are some very difficult questions to answer as we go forward. How does all this debt get paid for? And I guess different governments around the world will approach it in different ways. I don't believe that we're going to see any substantial slashing of public services in the very near term, the next 3 or 4 years or so. It's just politically not acceptable, and therefore we're going to see debt levels rise. The really big question is, what are they going to do from a taxation perspective, and how are the books going to be balanced? So in my view, I suspect we're going to see more in the way of tax rises rather than public spending reductions. But the question you asked is absolutely right. It creates instability, and maybe Mark can add to that as well.
Thanks, David. Yeah, it is a very good question, and it's in many ways the core question. And how do we get out of this huge debt pile? And I mean, if you look at what happened after the Second World War, the only sort of comparable era where we built up huge debts, the existential issues that resulted from the war. There was really a very deliberate policy of financial repression thereafter, essentially ensuring that inflation was at a slightly higher level than interest rates. And over a 20-30 period of time with compounding, a lot of the debt was paid down. That, of course, was in an era when it was easier to do that. There was far less credit in the economy. You had credit controls, and therefore you as an individual, you were not able to tap into the global capital markets. So difficult to see how that can entirely be replicated. But I think the question is a very good one, and I saw it obviously as a member of Parliament, and particularly in the sort of seat I represented, which was in central London, which had a significant amount of social housing, the have-nots, as it were, as well as those who were extremely wealthy. And as you rightly say, the impact of quantitative easing. And I often remark upon this. We've had the emergency interest rates now since March of 2009. This is for 11 or almost 12 years. Interest rates have not been higher than 0.75% in the UK, and it is a massive distortion that's been going on. And in many ways, there was an opportunity probably in the middle of the last decade to start trying to move to some sort of normalcy of interest rates, but it didn't really fit in with the political the electoral timetable, when there was a chance when Mark Carney might have seen interest rates coming back up a little bit in order to perhaps bring them down when the next downturn hit. But the worrying thing is, I mean, we all know how electoral cycles work, and the economic cycles of 7 years fat, 7 years lean. We were already at the end of the upturn that started from the beginning of 2009. It was quite a long cycle, and obviously COVID and the impact of that will be very fundamental. But no, it's, I mean, the worry that, I used to articulate this as an MP as long as 10 years ago. One of the biggest concerns we even had then, and of course it's been compounded, I think, by events since, is a sense that many of us, relatively middle class, who've got some assets, the biggest concern we have is a sense that our children are going to be less well off than we are. What we took for granted of getting onto the housing ladder in our early to mid 20s, all the opportunities that arose are going to be far more difficult for that next generation. And that, I think, is going to be an issue that is going to be very, very difficult to manage. And the truth is, and we've seen it, with the rise of Donald Trump in America, there will always be populists who will play to the gallery to suggest that there are easy solutions to this. Actually, there aren't easy solutions. It's a long-term haul to get out of it. That's, as I say, what happened with the financial repression after the Second World War, where there was essentially a 30-year strategy, gradually, bit by bit, to inflate our way out of that debt. Very difficult to see how that can be replicated.
Thank you, Mark. Greg Easton, I'm going to come to you with a couple of ESG questions. One was, how do I move my existing portfolio into an ESG strategy? And then there are a couple of follow-on questions about how do ESG strategies performance compare against other investment plans, and what kind of returns can you expect?
Thank you, Greg, and thank you for the ESG questions. And if you look at returns first and performance of ESG, I think we're at a point now where the myth that ESG underperforms has pretty much been dispelled. If you look at the 10-year average annual return for the MSCI ESG Leaders Index, it's about 6.84%, which is about 0.25% higher than the MSCI All Country World Index. So performance-wise, net, they are on a par. And actually in our poll questions, I see that we've had some responses there that actually if performance was on a par, would you select an ESG option? And 100% of the respondents have said yes. So I think that's very encouraging to see. And hopefully to answer the second question there on how do you make that change, well, I think it's a time to sit down with your investment manager, with your advisor, and to look at your ESG objectives. Risk, volatility are still just as important with ESG assets as they are with traditional assets. And in many ways, it can be a gradual transition from your existing position to an ESG strategy, or you can set up a strategy to run alongside a traditional portfolio. So it really depends where you're sitting in your pace of change, how you want to change. And I'd really sort of encourage investors. I think once you start thinking about it from a sustainability perspective, you can't unthink it. So that change will come at some stage. And in many ways, that's what businesses are doing too. They're evolving their investment thinking. So it's a simple answer. You can make a switch. You can have the same asset allocation in terms of different asset classes, but just use ESG assets rather than traditional ones.
Thank you, Greg. We've got a question from Kevin Walmsley, my old colleague from Barclays days. Are we seeing a new tech stock bubble with the price of stocks such as Tesla reflecting overly optimistic earnings? David?
I'm just trying to avoid the "you're on mute" phrase that is, I think, probably the phrase of the year. By taking myself off mute, the answer to that question is yeah, I think we are. Tesla is a fabulous company, but I think its valuation now is roughly just short of $1.5 million for every car they produce in a year. Well, that kind of tells you it's maybe slightly overvalued. It's not to say it can't continue, but it is kind of bubble territory. And it's one of the reasons why I get a little bit nervous about the nature of the environment in which we're in, because this is very reminiscent of the sort of movements that you saw in stocks back in the late 90s, early 2000, before the dot-com crash. I say again, Tesla is a fabulous company, but it's gone way too far. Some of the other tech stocks that we know well, I would probably have a different view on. They're less overvalued than perhaps we might assume. Apple, for example, is perfectly reasonable in its long-term valuation. Microsoft also. But yeah, there are signs of a tech bubble developing in some stocks, without doubt.
Thank you, David. We've got an interesting question from Gary Manley to Mark, so lawyer to lawyer here. To what extent will the EU use the UK's desire to obtain equivalence decisions as leverage to require changes to the tax model of the Crown dependencies? And will the UK defend the Crown dependencies if it risks impacting the city's access to the single market? Well, this is a good question for Mark, because for many years he was a lone voice of advocacy for the Crown dependencies in the House. So can you pick that one up, please, Mark?
Well, I think one of the things I would say about tax regulation, there is a bit of a power grab going on, and the EU Commission feels it wants to take control. Of course, there are also moves to try and get global protocols, or at least protocols through the OECD, the organisation of the 37 largest, broadly the 37 largest Western economies. So I think that there is going to be a battle in that regard. And the truth, of course, is that we are no longer going to be at the table at the EU or the EU Commission towards making those sorts of decisions. And one of the things I've always been relatively relaxed about on financial services, although I think we have to recognise a lot of euro-denominated business will not take place in the UK in the medium term, and you'll see other financial centres getting a piece of that action. But one of the strengths that London had as a financial centre has always been both an onshore and an offshore centre. It's a centre for international capital coming in, as well as obviously being Europe's financial centre. And essentially, it will have to move slightly towards the offshore element of that. Now, where and therefore I think what Rishi Sunak has said the other day, I agree with, and that there is an opportunity for a sort of big bang Mark II, a big fundamental change in the way the city operates. It's clear, though, there isn't going to be a great appetite for massive deregulation. And not least because I think with all the issues around money laundering and terrorist financing, the notion of London becoming an easier centre for monies coming through from across the globe from some of the less or rather more nefarious areas will, I think, be strongly discouraged. I think from the Crown dependencies point of view, I mean, it's important that we recognise that inevitably the city and the UK government will have its own agenda, and they won't always be entirely aligned, and therefore it is all the more important, working together with Jersey and with Guernsey, working together with other overseas territories' financial centres, that we make the strong case for international financial centres, and recognise, as I say, that we can't always rely upon working with the Treasury. But I think that the very fact that the Isle of Man as a financial centre has often been ahead of the game, again working with smaller jurisdictions that have a similar view on this, I think puts us stands us in pretty good stead. But I think the more interesting thing, as I say, to watch for in relation to the European Commission is the power grab that it is having and the battles it's having with the OECD. And I think we should certainly be looking to side with the latter organisation as the home of those global protocols.
Thank you, Mark. There's a question from Dan Smith for David. What is your view on frontier markets?
Golly, that's a good question. Frontier markets are essentially smaller than typical emerging markets, but fairly well developed, typically off the radar of most investors because of their size. I see perfectly good opportunities for those markets to do pretty well, largely depending on where they're geographically located. Certainly, the whole of the Asia region is going to feed off of the success of China, and I think frontier markets connected with that are going to do well. I think it's very difficult for many investors to get good exposure to that kind of market. It presents quite a significant risk, and I would suggest, if one wants to get that kind of exposure, you do so through a specialist fund that is expert in managing investments in those markets. And it probably shouldn't be the lion's share of your portfolio, but an interesting area of development.
Thank you, David. There was a question from Vikas Kichi, which was around technology in wealth management and what our view is on how that evolves. I'll share a couple of thoughts, and the rest of the panel are welcome to add. We've been looking at this intensely for the last 5 years or so in looking at how we evolve Capital International. You have to consider not just what you need to use technology for to provide service today, but you have to anticipate how the needs of consumers and businesses are going to change over 3 to 5 years. And when I consider where the whole wealth management landscape is going, I think we're going to see more open platform type foundations for the provision of service with API connectivity, data sharing, so that your wealth manager almost becomes like your iPad, and the services that you can source from other parties become like applications that you get on an iStore, so that ultimately the services that you're able to avail of become very personal to you. And that's a vision that I see quite clearly for wealth management, banking, investments over the next 3 to 5 years. The innovation that's being created by small startup entrepreneurial types is then being harnessed and supported by the bigger traditional organizations. And we're very much doing a lot of our own research to think about how we evolve capital to take advantage of that kind of landscape. David, is there anything you want to add to that?
Yeah, I very much support your comments there. I think it's quite an exciting area, and sort of broaden it to fintech generally, I think, is another massive theme of this decade. For our own part, we have developed our own very sophisticated profiling technology that we use internally to help clients find the right strategies for them, and that technology will be being rolled out to external audiences later on this year, probably second half of this year. And obviously we're not alone. A lot of other companies are doing similar things. I'm not a huge fan of robo, if that's the right term. It has proved reasonably popular in some instances, but I kind of take it as a bit of a misnomer. And most of what I see in terms of robo advice is actually just pigeonholing of people rather than really giving them any form of advice. The other problem, I mean, we've seen companies like Nutmeg that perhaps led the way and have been around for as part of a decade or so, and have certainly built up a customer base, but they have yet to make any money, and they're losing money hand over fist. So I'm not sure that necessarily is the right way forward. But increasingly investors are wanting to use more sophisticated financial tools and fintech, and they want to make their own decisions, but they want to have those tools at their disposal. And I think that's what we're going to see.
Great, thank you, David. I'm going to start wrapping up now because I promised we would be done before 10 o'clock. I just want to reflect on the polls and what they're telling us before we do. The first question was, of the investment themes discussed today, which do you think will perform best in 2021? 21% went for UK value stocks, 25% megatech stocks. Renewable energy, 46%. Greg, your message is getting through. And agriculture, 7%, so an interesting split there. 100% of people would support choosing an ESG portfolio versus a traditional one if the performance were consistent, which is great to hear. 89% have said ESG is important in making investment decisions for your clients. Again, really good to hear. For a GBP denominated equity portfolio, what percentage of asset allocation do you expect to see invested in UK companies? Nearly half of people have said 50 to 80%, which lends itself to some of the value that you were talking about, David, in the UK market ahead, and a similar amount of people, 20 to 50%. So very much in that middle range. With interest rates likely to remain low during 21, would you consider an investment grade fixed income portfolio alongside cash management? 62% said yes. Are you interested in using our new banking service? 61% said yes. Most of the others said it's not relevant to me. So some really fascinating feedback there. I just want to end by thanking Mark Field, David Long and Greg Easton for their contributions today. I also want to say a thank you to Mina Perup, just outside my office here, in our marketing team, who's worked very hard, mostly to coach Mark Field on how to use this sort of technology.
Really, Greg, that's a bit unfair.
But she's done a super job to bring this into an online world in only a few days. We were going to be meeting face to face today. And finally, I'd like to thank everyone that has attended today. I really appreciate you giving your time. I hope you found it useful. Feel free to let us have feedback for further ideas. for future webinars or conferences. But for now, thank you to you all. I hope you have a great day and wishing you all the best for a prosperous 2021. Thank you very much.
Thank you, everybody.